People put too much attention onto what the Federal Reserve is or isn't doing with their interest rates. Goldman Sachs kind of backpedaled on their $3,000 gold here this year because, the Fed may not lower rates because inflation's reemerging and means nothing. Ultimately, we'll see the price continue to move higher. It moved up 30% this year. It's averaging 9.9. So even using 9.9% from where we are at 26.50, that puts us at 3,000. Dang close to it anyway. Nonetheless, I think they want to increase liquidity and debase the currencies. All of them do, to make paying off this debt easier, which leads to high inflation. Above expectations, I think this will drive investors back to gold.
The gold market will continue strengthening in early 2025, with prices maintaining gains despite short-term fluctuations. The precious metal has already appreciated approximately 30% this year, and analysts project further upside potential toward the $3,000 level, according to Andy Schectman, CEO of Miles Franklin. In Wednesday's European trading session, gold exhibited modest gains while encountering resistance near $2,665. Market sentiment remains influenced by several factors, including uncertainty surrounding U.S. trade policies, geopolitical tensions, and broader risk aversion in financial markets. Schectman identifies two key factors that could drive gold prices higher. First is the potential for central banks to implement new quantitative easing (QE) programs to respond to stress in the financial system caused by elevated interest rates. Second is the possibility of additional banking sector instability in 2025, which could catalyze increased demand for safe haven assets. Monetary policy developments continue to play a crucial role in gold's trajectory. Market participants closely monitor the Federal Open Market Committee minutes for insights into the Federal Reserve's interest rate decisions. The U.S. Treasury market has seen the 10-year benchmark rate reach a 9-month high of 4.697%, reflecting ongoing tensions in debt markets. The banking sector's stability has emerged as a significant concern following the failure of First National Bank of Lindsay, marking 2024's second U.S. bank collapse. The Federal Deposit Insurance Corporation estimates a $43 million impact on its deposit insurance fund. Regulatory authorities have assured customers of continued access to insured deposits and standard processing of banking operations. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
People put too much attention onto what the Federal Reserve is or isn't doing with their interest rates. Goldman Sachs kind of backpedaled on their $3,000 gold here this year because, the Fed may not lower rates because inflation's reemerging and means nothing. Ultimately, we'll see the price continue to move higher. It moved up 30% this year. It's averaging 9.9%. So even using 9.9% from where we are at 26.50, that puts us at 3,000. Pretty dang close to it anyway. But look, I think one of the things that I would be concerned about, one of the things that I think could, or several of the things that I think could ignite that fuse, let's start with the banking or financial crisis. Things that are very systemic in the financial system. And I think that's one of the things that could ignite that type of an event. And I would bet dollars to donuts that we will see many more banking failures in 2025. Will they be like Bank of Lindsay, Oklahoma, which was the first bail-in, and yet no one talked about it, but I did. I screamed about it. But where was CNN and Bloomberg and Fox and all of the so-called media pundits? Those folks lost half of their uninsured deposits, and they're not getting them back. And so that's an interesting thing. I think that aggressive monetary easing. So the central banks may need to implement large-scale quantitative easing again, right? Because interest rates are increasing, and that will destroy the banks, and that will destroy the market. That's why Trump wants low rates, also to make money easier and stimulate the economy. But you saw what's happened. The Fed lowered the rates on the front end by 100 basis points. In the back end, the 10-year Treasury went up by at least that much, if not more, signaling, no, this ain't going to be easy. We will not take any duration Treasuries. The bond vigilantes won't, unless the rate goes higher. Ultimately, the rate goes higher, but I could see them quantitatively easing to drive down the rates, and then also yield curve control, where they're buying the back end of the bond market because no one's stupid enough to do it, creating a very big problem in the bond market. But nonetheless, I think they want to increase liquidity and debase the currencies. All of them do, to make paying off this debt easier, which leads to high inflation. Above expectations, I think this will drive investors back to gold and silver as inflation hedges, is the realization that the Fed has already waved a white flag to inflation. They're 65% away from their target rate based upon the Fugazi numbers that they use, which, the CPI is a CPI. It's way off base from what real inflation is, and they continue to massage and change it. In April of last year, coffee was up 85%, so they replaced it with tea. That's what they do. It's a big and total lie. It excludes food, energy, and housing, the things that are going up in value. It's a huge lie because everything is based off of this hidden inflationary agenda. But I think you will see the realization that, look, if the Fed was if why are they lowering rates on the front end of the curve if they're still 65% away from their target, even using the fake numbers? So you're driving across the country from California to New York, and you decide to stop in Omaha because, well, that's far enough. We've won. We're there. We still have 65% of the way to go, but it's good enough. We'll call Omaha the new New York City. I mean, that's really what it is. And I guess the last thing I'd say is a continued dollar weakness or what they want. The dollar's been going straight up, not what they want, but they want a decline in the U.S. dollar relative to other currencies. That's what Trump is talking about. He doesn't have the power to do it, but he is talking about it. That's what he wants.
The emergence of gold ETFs in 2004 marked a significant shift in retail investment accessibility, with holdings reaching unprecedented levels during the 2020 COVID-19 pandemic lockdowns. However, these positions have since receded to pre-pandemic levels, reflecting the responsive nature of retail investment behavior. The report indicates that retail ETF flows typically respond to specific market catalysts. In contrast to retail investors' shorter-term approach, institutional investors demonstrate a markedly different strategy. Pension funds and foundations typically maintain physical gold positions spanning decades, representing a more stable and permanent portfolio allocation. This long-term institutional presence provides a foundation for steady gold market demand. Andy Schectman pays attention to J.P. Morgan's significant position in gold and silver ETF management in his market structure analysis, potentially facilitating a gold-centered financial restructuring while preserving the distinction between institutional and private holdings. Let's get back to the interview.
I think that, look, the Bank of International Settlements wouldn't have reclassified gold as the world's only other tier one reserve asset. We put this if it weren't part of the plan moving forward. And the accumulation by the central banks doubling and tripling down recently would not have happened or continue to happen following a 2-3 year trend if there weren't some very substantial things coming for gold. Something just happened that really caught my attention. So we've always talked about J.P. Morgan's role in suppressing metals and how they paid a $920 million fine for manipulating the metals market, right? And they were the custodian and still are the custodian of the world's largest silver trust, SLV. So here it is, a company that admits to manipulating the market. Their head trader, Michael Nowak, who I've met before, is still in prison for manipulating the silver market. And they're allowed to continue to be the custodian of the world's largest silver trust. And then we would always, obviously, people would say, do you think gold will be confiscated again? And I would always say, well, to me, it wouldn't do them any good to confiscate the gold. It would be better to confiscate the ETFs. I've said that on 500 podcasts, going way back. I mean, way back. Even before J.P. Morgan was known to be who they are. So I said, look, it would be much easier to take the gold held by the ETFs, which would be the largest stockpile of silver and the fourth or fifth largest stockpile of gold, without breaking any laws or infringing any civil liberties. Be much easier to do that. Look the world in the face, say, well, we didn't do anything. You can still buy this stuff physically. We just closed a couple of ETFs, which we have the right to do. So HSBC Bank was always the primary custodian of GLD. Well, guess who it is now? JP Morgan. actually has now become, it has taken joint custodianship of the world's largest gold exchange traded fund. And it's now transferring all of the bullion that's inside of the vaults to their own vaults in London and New York. And it's interesting. JP Morgan now, with between the gold and the silver, just the gold alone that they're holding on behalf of GLD, it's a greater total of gold reserves than a large majority of the G20 nations. And so it's interesting when you think about this. Why would they do this with no obvious gain, or et cetera? Are they doing it because they were told to do it? Maybe. Are they preempting something? Is gold going to play that integral role, like Judy Shelton talks about? The BIS reclassifies it, and the BIS, you guys, they're the world's most powerful bank on the planet. They wouldn't reclassify gold tier one, the only other tier one other than U.S. Treasuries, if it weren't important. The unit, as you talked about, 40% gold backing, deliverable upon request. Central banks buying it hand over fist. Where's Bitcoin in all that? The public's sure buying it, and it's done really well. Why aren't the central banks doing it the same way? They talk. Cynthia Loomis talks about the Bitcoin strategic Bitcoin reserve here in the United States. Well, funny, she also talks about funding it by revaluing the gold held supposedly by the Fed on behalf of the Treasury. Revaluing it to what? And why did JP Morgan take possession or be the custodian of both SLV and GLD? Could they say, we're going to confiscate those two funds and remonetize or revalue the price of gold? Those of you that still own physical, you can keep it. Instead of, doing this 1933 executive order to steal gold, they would just take all of it held by JP Morgan with a big pink bow wrapped around it, massive stockpiles, and let the little crumbs that the rest of us public own.
Gold's enduring strength amid evolving economic uncertainties highlights its dual appeal as a secure store of value and a strategic investment tool. While retail investment behaviors may fluctuate in response to immediate market conditions, the unwavering commitment of institutional holders underscores the metal's foundational role in diversified portfolios. Coupled with central bank actions and potential monetary policy shifts, the gold market's outlook remains robust, indicating sustained relevance in an unpredictable global financial landscape. What factors do you think will significantly influence gold's performance in the next economic cycle? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.